Hey everyone, welcome back to the channel. If you've been struggling to find a simple yet powerful trading strategy that actually works, this is the video you've been waiting for. Today, I'm going to break down one of the most beginner-friendly yet incredibly effective strategies using MACD RSI and the Stochastic Oscillator. You'll learn exactly how to use these tools together to spot high-probability trades without the guesswork. This is the strategy most traders overlook, and by the end of this video you'll know how to use it to trade Forex, stocks, or even crypto. So if you're ready to finally stop trading blind, smash that like button, hit subscribe, and let's get right into it. Let's start with the first tool, the Stochastic Oscillator. Now don't worry, this isn't some complicated formula. It's a momentum indicator that compares the current closing price to the price range over a certain period. You'll see two lines on the chart. The red line is called %K and the blue one is %D. When both of these lines are below 20, that tells us the market is oversold. In simple terms, the price dropped too far, too fast, and could be ready to bounce. On the other hand, when both lines are above 80, the market is overbought. That means it might be time for a pullback or reversal. But here's the deal. We don't use this alone. That's a rookie mistake. So now we add a second filter, the RSI. The Relative Strength Index, or RSI, is also a momentum indicator. Most people use it to look for overbought and oversold levels, but we're going to do something smarter. We're going to use the 50 level to filter the trend. If the RSI is above 50, we assume the market is in an uptrend. If it's below 50, we assume the market is in a downtrend. This keeps us from entering trades that go against the main direction of the market. It's like trading with the current instead of swimming against it. And finally, the third confirmation tool, the MACD. MACD stands for Moving Average Convergence Divergence. Yeah, sounds complex, but we're only focusing on one thing, crossovers. You've got two lines here too, the MACD line and the signal line. When the MACD line crosses above the signal line, that's bullish momentum. When it crosses below, that's bearish momentum. When used in combination with Stochastic and RSI, it becomes a powerful confirmation tool. Let's tie it all together now into a simple step-by-step strategy. Let's say we're looking to go long, meaning we want to buy. Step 1. The stochastic lines should both be below 20. That tells us the market is oversold. It's potentially bottoming out. Step 2. The RSI should be above 50. That confirms that we're in an uptrend. We don't want to go against the market. Step 3. The MACD line should cross above the signal line. That's your green light. Momentum is turning in your favor. And finally, make sure that the stochastic hasn't already moved above 80. If it has, you're too late. If all those boxes are checked, you enter the trade. Now let's reverse that for a short trade. Step 1, both stochastic lines should be above 80, signaling an overbought condition. Step 2, RSI should be below 50, confirming a downtrend. Step 3, MACD line crosses below the signal line, confirming bearish momentum. And again, make sure stochastic hasn't already dropped below 20, or you've missed the move. Once you enter, it's time to talk about exits, something most traders ignore, and it costs them big. For take profits, you want to target the next support or resistance level, depending on your direction. Or you can use a risk-to-reward ratio like 1:2 or 1:3, meaning if you risk $50, your target should be $100 or $150. Stop losses? For long trades, set it just below the recent swing low. For shorts, just above the recent swing high. And here's the golden rule. Never risk more than 1% of your account on any trade. If you're trading a $5,000 account, your risk should be around $50 per trade. This way, even if you take a few losses, your account stays healthy and you can bounce back strong. Now let's look at some real chart examples so you can see how this strategy plays out in the real world. Here's an example with EUR/USD. We see the stochastic drop below 20, the RSI is above 50, MACD crosses up. Perfect entry. We ride it to the next resistance level and boom, we're out with a solid profit. Here's another, a short trade on Tesla. Stochastic is in the overbought zone. RSI dips below 50, MACD crosses down, everything lines up, we take the trade and the market drops right after. Clean win. You'll start to see this setup repeat itself over and over across all markets. Now why does this strategy work so well? Because it combines three different layers of confirmation. The stochastic tells you when to enter. The RSI tells you the direction of the trend. The MACD tells you if there's momentum behind the move. It's like having three traffic lights turn green at the same time. That's your go signal. Just remember, no strategy is perfect. There will be losses. But by managing your risk and waiting for all conditions to line up, you'll stack the odds in your favor. So, key takeaways? Use the stochastic for entry, RSI for trend confirmation, MACD for momentum. Don't skip risk management, always test on demo before going live, and keep practicing. That's how pros are made. Gap 3S. In this chapter we will dive deeper into the MACD indicator, exploring its historical significance and how it has evolved over time. We'll uncover the origins of the moving average convergence divergence, or MACD, and how it has become a staple in the toolkit of traders worldwide. Gap 1S. The MACD was developed by Gerald Appel in the late 1970s as a way to identify changes in the strength, direction, momentum, and duration of a trend in a stock's price. Originally designed to be a simple yet effective tool, it has since undergone several modifications to adapt to modern trading environments. Gap 1S. We'll also discuss advanced strategies for using MACD in different market conditions. For instance, in a trending market, traders might look for MACD crossovers to confirm the trend's strength. Conversely, in a ranging market, the MACD can help identify potential reversal points. Gap 1S. By the end of this chapter, you'll have a comprehensive understanding of the MACD indicator, from its historical roots to its modern-day applications. Whether you're a novice trader or a seasoned pro, these insights will help you leverage the MACD to its fullest potential. Gap 2S, so get ready to enhance your trading strategy with the power of the MACD. Let's dive in. Now that we've explored the intricacies of the MACD, let's take a closer look at another essential tool in your trading arsenal, the RSI indicator. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. Developed by J. Wells Wilder Jr. and introduced in his 1978 book, New Concepts in Technical Trading Systems, the RSI has become a widely used indicator for identifying overbought and oversold conditions in the market. The RSI is calculated using the formula RSI = 100, 1 plus RS, where RS is the average of N days up closes divided by the average of N days down closes. The result is a value that ranges from 0 to 100, giving traders insights into the momentum of a given asset. When the RSI value is above 70, the asset is generally considered overbought, indicating that it might be due for a price correction. Conversely, when the RSI falls below 30, it is considered oversold, suggesting that the asset might be undervalued and due for a price increase. Traders can use these levels to make more informed decisions about when to enter or exit trades. For example, an overbought condition might signal a good time to sell, while an oversold condition could be a buying opportunity. By understanding the origins, formula, and practical applications of the RSI, you'll be better equipped to incorporate this powerful indicator into your trading strategy. Stay tuned as we delve even deeper into this fascinating tool and uncover advanced techniques for maximizing its potential. Let's get started. Welcome to the next chapter, where we will explore the stochastic oscillator in more detail. The stochastic oscillator is another powerful momentum indicator developed by George Lane in the late 1950s. It is based on the premise that closing prices tend to close near the high of the trading range during an uptrend and near the low during a downtrend. The stochastic oscillator consists of two lines, %K and %D. The %K line is the main line, and it measures the current closing price relative to the high and low of a specified number of periods. The %D line is a moving average of the %K line, which helps to smooth out the data and generate more reliable trading signals. The formula for the stochastic oscillator is %K = current close, lowest low, highest high, lowest low, asterisk, 100% D = 3-day SMA of %K. The result is a value that ranges from 0 to 100, similar to the RSI. A reading above 80 indicates that the asset may be overbought, while a reading below 20 suggests it may be oversold. However, unlike the RSI, the stochastic oscillator also considers the position of the closing price relative to the high-low range, providing additional context for interpreting market conditions. Traders often use the stochastic oscillator in combination with other indicators such as the RSI or MACD to filter out false signals and improve the accuracy of their trades. For example, a trader might look for a bullish crossover of the %K and %D lines in an oversold condition as confirmation of a potential buying opportunity. By understanding the development, theory, and practical applications of the stochastic oscillator, you'll be better equipped to incorporate this versatile tool into your trading strategy. Stay tuned as we continue to uncover advanced techniques and strategies for maximizing your trading success. Let's dive in. Welcome back. By now you've gained a solid understanding of the stochastic oscillator RSI and MACD. But how do you combine these powerful tools to create a more comprehensive and reliable trading strategy? Using multiple indicators together can help filter out false signals and provide a clearer picture of market conditions. For instance, imagine you're considering a long trade. The stochastic oscillator shows an oversold condition with a bullish crossover, indicating a potential buying opportunity. However, to avoid false signals, you also check the RSI, which confirms that the asset is not in an overbought territory. Finally, you look at the MACD to ensure that the momentum is shifting in your favor. By combining these indicators, you create a multi-layered confirmation system that increases the likelihood of successful trades. This approach helps you identify high-probability trade setups and minimizes the risk of entering trades based on a single indicator. In the upcoming sections, we'll provide practical examples of how to apply this multi-indicator strategy in real-world scenarios. Stay tuned as we continue to refine your trading skills and strategies. Let's dive deeper into the world of comprehensive trading. Welcome to the next chapter. Now that we've discussed how to combine the stochastic oscillator RSI and MACD for a comprehensive trading strategy, it's time to see it in action with real-world examples. In this chapter, we will provide real-world examples of successful trades using the combined strategy of MACD, RSI, and stochastic oscillator. We will analyze these trades to understand what made them successful. Let's start with our first example, a long trade on Apple Inc., AAPL. Here, the stochastic oscillator indicated an oversold condition, and we observed a bullish crossover. To confirm this signal, we checked the RSI, which was comfortably above the 30 level, but well below the overbought territory, indicating room for upward movement. Finally, the MACD showed a positive cross, signaling increasing bullish momentum. By aligning these three indicators, we entered the trade and saw significant gains as the stock price surged. Next, let's examine a short trade example on the EUR-USD currency pair. The stochastic oscillator signaled an overbought condition, and we noticed a bearish crossover. The RSI confirmed that the currency pair was not in oversold territory, suggesting further downside potential. The MACD also showed a negative cross, indicating a shift towards bearish momentum. Combining these signals, we entered the short trade and captured substantial profits as the price declined. Through these examples, we can see the power of using a multi-layered confirmation system. By leveraging the strengths of the stochastic oscillator RSI and MACD, we can filter out false signals and identify high-probability trade setups. Stay tuned as we continue to refine your trading skills and strategies by diving into more practical applications and advanced techniques. Up next, we'll explore how to use these indicators in different market conditions and time frames. Welcome to the next chapter. Now that we've explored real-world examples of successful trades, let's shift our focus to an equally important aspect of trading, the psychological side. Trading isn't just about numbers and charts, it's also a mental game. Maintaining discipline, managing emotions, and sticking to your trading plan are crucial for long-term success. First, let's talk about discipline. Discipline means sticking to your strategy, even when the market is volatile. It's easy to get swayed by sudden price movements, but remember, your strategy is designed to navigate these fluctuations. Trust the process. Next, managing emotions. Trading can be an emotional roller coaster. Fear and greed are two powerful emotions that can cloud your judgment. Fear can make you exit trades too early, while greed can make you stay in trades too long. The key is to remain calm and collected, making decisions based on your strategy, not your emotions. Finally, sticking to your trading plan. Your trading plan is your roadmap to success. It outlines your entry and exit points, risk management rules, and profit targets. Deviating from your plan can lead to inconsistent results and unnecessary losses. To help you maintain discipline, manage your emotions, and stick to your plan, consider keeping a trading journal. Documenting your trades, the reasons behind them, and your emotional state can provide valuable insights and help you improve over time. Remember, successful trading is a marathon, not a sprint. By mastering the psychological aspects of trading, you can achieve consistent, long-term success. Stay tuned as we continue to refine your trading skills and strategies. In the next chapter, we'll explore how to use these indicators in different market conditions and time frames. Welcome back! Now that we've delved into the psychological aspects of trading, it's time to enhance our understanding of risk management. In this chapter, we'll explore advanced risk management techniques that can help safeguard your trading capital and ensure long-term success. First, let's talk about position sizing. Position sizing is crucial because it determines the amount of capital you risk on each trade. A general rule of thumb is to risk no more than 1 to 2% of your trading capital on a single trade. This approach helps you withstand a series of losses without significantly impacting your account balance. Next, setting stop-loss orders. A stop-loss order is a predetermined price level at which you'll exit a trade to prevent further losses. It's essential to set your stop-loss orders based on technical analysis and not just an arbitrary number. This ensures that your stops are placed at logical levels, such as support or resistance zones. Now, let's discuss protecting your trading capital. One effective way to do this is through diversification. By spreading your investments across different assets or markets, you reduce the risk of a significant loss from any single trade. Additionally, regularly reviewing and adjusting your risk management strategy is vital to adapt to changing market conditions. Another key aspect of risk management is understanding your risk-reward ratio. This ratio compares the potential profit of a trade to its potential loss. Aim for a risk-reward ratio of at least 1:2, meaning you're willing to risk $1 to gain $2. This helps ensure that your profitable trades outweigh your losing ones. Finally, consider using trailing stops. Trailing stops move with the price of the asset, allowing you to lock in profits as the price moves in your favor, while still protecting against significant losses. By incorporating these advanced risk management techniques into your trading strategy, you can better protect your trading capital and improve your chances of long-term success. Stay disciplined, manage your risk wisely, and always stick to your trading plan. In the next chapter, we'll explore how to use these indicators in different market conditions and time frames. Stay tuned. Welcome back! Now that we've covered advanced risk management techniques, it's time to dive into a crucial aspect of trading that often gets overlooked: backtesting your trading strategy. Backtesting involves applying your trading strategy to historical market data to see how it would have performed in the past. This process helps you understand the strengths and weaknesses of your strategy before risking real money. First, you'll need access to historical market data. Many trading platforms provide this data, or you can find it from various financial data providers. Once you have the data, the next step is to simulate your trades based on your strategy's rules. This can be done manually or using automated backtesting software. As you run your backtest, pay close attention to key metrics like the win rate, average profit loss per trade, maximum drawdown, and the risk-reward ratio. These metrics will give you valuable insights into the viability of your strategy. Interpreting the results is crucial. If your backtest shows consistent profitability, it indicates that your strategy has potential. However, if the results are less favorable, don't be discouraged. Use this as an opportunity to tweak and improve your strategy. Adjust parameters, refine entry and exit rules, and ensure that your risk management techniques are solid. Remember, backtesting is not a guarantee of future success, but it does provide a statistical foundation for your trading decisions. By rigorously testing your strategy, you can gain confidence and reduce the emotional stress that comes with live trading. In the next chapter, we'll explore how to use these indicators in different market conditions and time frames. Stay tuned. Welcome back. Now that we've delved into the importance of backtesting your trading strategy, it's time to explore another powerful tool in your trading arsenal, the trading journal. A trading journal is more than just a log of your trades. It's a comprehensive record that helps you analyze your performance, identify patterns, and refine your strategy. So, how do you keep an effective trading journal, and what information should you include? First, document every trade you make. This includes the date and time, the asset, the entry and exit points, the position size, and the outcome of the trade. But don't stop there. Include the rationale behind each trade. What indicators or signals prompted you to enter the trade, and what was your exit strategy? Next, jot down your emotional state at the time of the trade. Were you feeling confident, anxious, or impulsive? Emotions can significantly impact your trading decisions, and recognizing emotional patterns can help you manage them better in the future. Review your journal regularly. Look for recurring themes or mistakes. Are there certain times of day when you perform better? Are there specific market conditions where your strategy excels or falters? By analyzing this data, you can make informed adjustments to your strategy and improve your overall performance. A trading journal also serves as a motivational tool. It provides a clear record of your progress and helps you stay disciplined. When you see your growth over time, it reinforces positive habits and keeps you focused on your long-term goals. Remember, the key to a successful trading journal is consistency. Make it a habit to update your journal after every trade and review it periodically. This ongoing process of documentation and analysis will not only help you refine your strategy, but also build confidence and reduce emotional stress. In the next chapter, we'll explore how to use these indicators in different market conditions and time frames. Stay tuned. Welcome back. Now that we've explored the role of trading journals, let's take a look at some common mistakes traders make when using MACD, RSI, and the Stochastic Oscillator. Understanding these pitfalls and knowing how to avoid them can significantly improve your trading results. First, let's talk about MACD. One common mistake traders make is relying solely on MACD crossovers for trade signals. While crossovers can be powerful, they shouldn't be used in isolation. Always look for confirmation from other indicators or price action to avoid false signals. Next, the RSI. Many traders misuse the RSI by taking overbought and oversold conditions at face value. Just because the RSI is above 70 or below 30 doesn't mean an immediate reversal is imminent. Always consider the overall trend and other market conditions before making a trade based solely on RSI levels. Now, the stochastic oscillator. A frequent error is ignoring the context of the market when using this indicator. In a strong trending market, the stochastic oscillator can remain in overbought or oversold conditions for an extended period. Use trend filters to avoid counter-trend trades and focus on high-probability setups. To avoid these mistakes, always use a combination of indicators and price action analysis. Diversify your strategy by incorporating multiple layers of confirmation, as we've discussed in previous chapters. This will help you filter out false signals and make more informed trading decisions. Stay disciplined and patient. Rushing into trades based on a single indicator can lead to unnecessary losses. Take your time to analyze the market comprehensively before making a move. In our next chapter, we'll dive into how to use these indicators in different market conditions and time frames. Stay tuned for more insights to enhance your trading strategy. If you got value from this video, do me a favor. Hit that like button, comment below with any questions, and subscribe for more no BS trading strategies that actually work. Thanks for watching Trade Smart, stay patient, and I'll see you in the next one.